Hi everyone, and welcome to Pepper Money's Navigating the Road Ahead webinar. I'm your host, Matt Perry, Head of Product at Pepper Asset Finance. And for the next 45 minutes, I'm going to put our Treasurer, Anthony Moir, on the hot seat to better understand what's happening in the marketplace. We'll unpack the latest economic shifts, along with what it means to us in asset finance. Before I kick off, I'd like to begin and acknowledge traditional owners of the land that we meet today. I'd always like to pay respects to the elders past and present. The format today will be Anthony doing a presentation on the economic outlook, along with some key market insights. We'll then be followed by a Q&A session, which will give you the opportunity to ask some questions. Please pop some questions into the chat and we'll get to as many of them as possible. After the call, if we can't get to all of them, we will get back to you. At this point, I'd like to introduce Anthony Moir. Anthony has over 30 years of experience in the industry. He has held several senior roles in Citibank, AMP, GE Capital, Treasurer at Kudos Bank, and been our Treasurer here at Pepper Money for nearly 5 years. Anthony has been the driving force behind expansive funding capabilities within Pepper Money. And before I kick off, I would just like to share how the session came around today. Myself and Anthony live quite close together and share numerous train journeys. The train journeys normally consist of three things. One, complaining about the neighbours. Two, trees falling down and hitting things. And three, the economic climate. So today, given that information, I thought it'd be great to put this session together and share Anthony's great insights with a wider audience. You'll be pleased today to know we're not talking about trees falling down. With that, I'd introduce Anthony to the call.
Great. Well, thank you, Matt. And firstly, thank you so much for the opportunity to speak to you today. One thing Matt didn't mention is that I'm a natural pessimist, which is great when you're a treasurer, because the last thing you want to be is too optimistic and then find out there's not enough money in the bank account. So that's why it's a little bit unusual for me today to say that I'm feeling pretty good about the economic outlook. And I want the key takeaway for you to be that your clients are going to become increasingly more positive over time, which is going to be great for them and great for your businesses. So why do I feel that way? Well, they've had a really tough period. Rate increases, living cost increases, but it feels like now we're somewhat getting used to these higher mortgage repayments, what I call eye-watering electricity prices. The fact that a box of veggies cost you about $100 for a small box, that is, and insurance premiums that come in just about every time and you go, are you kidding me? How can it be so much? But the reality is that there's some real positive green shoots in the economy. Rates coming down, house prices are going up, funding conditions are extremely favourable for us lenders. Lending competition is fierce, which is a great outcome from your borrowers and yourselves. Employment remains very strong, and business confidence, although it's a bit lagging, it will improve as businesses get encouraged by the improved consumer, who increasingly are starting to spend the extra money that they've got. The lending market is definitely open. So let me expand on each of these points. First of all, what's the outlook for interest rates? Everyone's always interested in this one. July was really interesting. I think the RBA surprised us by not cutting in July. The market had pretty much factored it in. It was like a 90% probability, and they didn't cut. Why didn't they cut? They were being really cautious. What they said was they were going to take a cautious and gradual approach to rate reductions. Effectively, they wanted to see what the quarterly CPI number delivered. When that quarterly CPI number come in and it come in below their target, that pretty well concreted the August cut, which we received. So what's the position from here? Most people, including the market, so most banks and the market, believe that the November 25 cut is pretty well guaranteed. So we'll get a 25 basis point rate cut in November is the expectation. But the outlook for 26 is a little bit uncertain, and we've got some differences between what the market says and what some of the major banks say. So Westpac's the most aggressive. They think we're going to get the November cut plus another 2 in 2026, bringing the cash rate down to 285. ANZ and CBA believe it'll just be the November cut and there won't be any in 2026. And the cash rate will stay at 335. And NAB's in the middle. They think that there's going to be 2 further cuts, bringing the cash rate down to 310. The market's fully priced in the November cut, or close enough to, and they think there's going to be another one. so bringing the terminal cash rate down to 3.1%. So why the cuts? The interesting thing is that inflation is definitely on a downward trend and is under control. So we had this post-pandemic inflation surge. Inflation peaked out at 6.8%, but it's now within the target band and it's been there for the 2 quarters. Why is that the case? We're seeing easing servicing inflation. It's now back to the historical average, especially in healthcare, education, and hospitality. We're seeing declining dwelling costs. So the cost of new dwellings is coming down. We're seeing some weak household consumption. Some of that was volatility caused by the flooding in New South Wales and Queensland and some of the economic disruptions that we're seeing globally. And that global uncertainty, rising tariffs, trade tensions and the like, particularly between the US and China, is leading to weaker global demand, which is bringing down that inflation. And wages are pretty well under control. As we all know, if you're working in the private sector, pretty hard to get a pay increase. And it's not just Australia where inflation is under control. So if you look at the major economies, US, Canada, UK, Europe, New Zealand, you can see from that chart, they've all got inflation under control. And the key themes are energy prices are falling, especially oil and coal. We're seeing normalized supply chains after the post-pandemic situation, somewhat weaker consumer demand, tighter monetary policy, so rates had been increased, and there's global trade uncertainties. Most central banks are cutting rates as well. The Fed meets tomorrow, and the expectation is that they will cut rates, and they're going to cut rates by up to 150 basis points from now to the end of 26. And that's going to take their long-term rate to, take their rate to what they call the long-term neutral estimate of 3%. And you can see from that graph, other central banks are expected to cut rates as well. And as we all know, declining interest rates is a great thing for property prices. In fact, house price expectations are at a 15-year high and home prices are increasing quite strongly. So August saw a 0.8% increase in the Totality Home Value Index. Over the last 4 months, that was tracking at about a 0.5 to 0.6% increase. So that is a stepped increase to go up to 0.8%. Houses are now increasing by about an 8% annualized rate. So very strong house price growth. And funding conditions are remarkably strong. So we had this period of volatility where the cost of banks and non-banks to go and obtain debt spiked considerably after the Liberation Day tariff situation. But as you can see from that graph, they've come screaming down to the point where we're seeing some of the tightest credit spreads that we have seen historically. So funding conditions are extremely favorable. There is a ton of money out there for banks and non-banks alike, and it's providing very cost-effective funding opportunities, even with some of this tariff uncertainty and global uncertainty around US and China tensions. The ease of this funding and the competitiveness of this funding is really driving strong competition. Borrowers have an unprecedented choice from the big banks, non-banks, and niche fintechs. Lenders are competing on rates, features, speed, service, and we're driving innovation and better deals. It's a really great win for your clients, and it's a great win for your business. Now, employment is really steady. The current unemployment number is 4.2%. It indicates it's a really strong labour market, and participation rate, not surprising. People are out there working because they need to pay for these higher cost of living pressures. The participation rate's at a record high of 67%. Interestingly, underemployment is steady at 5.9%, which suggests that there is some slack in the labour market. Now, you may have heard that for a while, Australia has been in a GDP per capita recession. Very interesting. We are no longer in that position. So the first time since March quarter 2003, GDP per capita has increased in year-end terms. Household consumption grew an impressive 0.9% in the quarter, and that's the strongest increase since December quarter 2002. Tax relief and interest rate cuts are now supporting growth in disposable incomes, and some of the lower inflations means that price rises are not eroding the purchasing power the way that they did in 2022 and in 23. And the other big bugbear of the Australian economy that you hear about is that we are not productive, that we have low productivity. The good news is that it's improving materially and productivity growth is now normalised. Productivity ex the mining sector is running at 0.9 a year, and this is in line with pre-pandemic averages or the decade average. But back to the key takeaway. What does it mean? It means that consumers, although they're still feeling somewhat pessimistic, they've clearly turned the corner in terms of how they're feeling after the devastating impacts of the rate increases in 2022 and 2023. In fact, March was the highest consumer sentiment reading in 3 years, and it was driven by the RBA's interest rate cut, easing inflation, and improved sentiment around major purchases and personal finances. September dropped back a little bit because of that uncertainty in the rate outlook, but really interesting, that September number included a result around family finances that were the best since 2022, when price inflation and the associated cost of living problems were just taking off. Now, business sentiment is interesting. It has lagged that uptick in consumer sentiment, but stronger household consumptions and the uptick in the domestic economy will eventually encourage businesses to invest with a higher degree of confidence. The question is just how long that'll take, given some of the uncertainties. Interesting thing about business sentiment, though, is that it is at the level of its largely consistent with the historical norm. If we look at new car sales, August result was the second strongest result or August result on record, with over 100,000 new vehicles sold. EVs still struggling, 6.8% of that sales figure. Plug-in hybrids, 3.9% of that figure. But the Chinese brands are killing it. So 4 of the top 10 models were Chinese, and their year-on-year sales are up 67%. But there are some risks that we need to look out for. So what are some of those risks? Undoubtedly, cost of living pressures still remain. Over 50% of Australians feel worse off than a year ago. Economic nationalism and clean energy transition is still going to keep prices up in the short to medium term. And people are still struggling with their mortgages. 32% fear that they may need to sell due to the high repayments. People are still a little bit uncertain in their job, even though employment market is very strong, with 35% of workers worried about their employment. And company insolvencies are at record highs, with the ATO being extremely aggressive with debt collection. There's still a lot of global uncertainty that we're all aware of, especially around the trade tensions, and this is going to continue to cast a shadow. And banks are trying to reassert control. Priority channels are growing and brokers must defend their value. We've all heard about it to death probably, but the AI race is on, and productivity and client experience is going to be the battleground in this space. So what can you do? I think the first important thing to do is maybe you enjoy it for a while. Take advantage of the improving economic conditions and the improved consumer sentiment. Undoubtedly, we all need to embrace technology. We need to be aware of AI and, where possible, streamline operations and enhance your client's experience. At Pepper, we got quite a number of new products coming to market and new automation to enhance that broker and customer experience. I suggest you need to diversify your services if you already haven't done so. Have a suite of options for your clients, and definitely need to continue to deepen that client engagement Stay close to them, stay very relevant, and be that bridge between your clients and financial opportunity. So in summary, we've got a position where rates are falling, but some risks remain. Your clients are definitely coming into a period of being more optimistic. So it's a good time to stay proactive with them, take advantage of that change in their position. Competition is intensifying, so you need to differentiate through your service and insight. Some structural shifts are underway, such as AI. Unfortunately, we need to be across this. And more importantly, your role as a trusted advisor has never been more important. Thank you, Matt.
Excellent. Thanks, Anthony. Appreciate all your great insights there. Let's get stuck in some questions. It's great to hear you're feeling optimistic about the economic outlook. It's really good to hear. People on the call will be really interested to hear that. But bringing it back to asset finance, how do you see the outlook and how do you see it affecting the asset finance industry?
I think the positive thing is both. People are going to start to spend more. We've already seen that. They're feeling a little bit more comfortable with the outlook. This increased optimism means that they are feeling comfortable to make purchases, new car purchases, spend a little bit more on holidays, take a little bit more finance. So what that means ideally is that we continue to see some improvements in business conditions over time. Business will get more confident to invest. Individuals will get more confident to make expenditure, cars, improvement in the economy, just generally, GDP will go up.
Excellent. So can you explain people on the call as well? RBA rates not the only thing that makes us us at Pepper Money bring rates down or change rates. Can you explain how we calculate market rates, swaps, etc.? Can you just explain to the audience that?
Yeah, sure. So, Matt, as you know, all the products that we offer in asset finance are fixed rate. We price off a margin over the swap rate. Now, most of our products have an average duration of about 3 years. So the 3-year swap rate is the relevant rate for us to focus our attention on and to price our margin above. Now, what the 3-year swap rate is, it's pretty simple. All it is just the expectation of what the RBA will do over the next 3 years and average that. So if the market feels the rates are going to go down and stay down, then the 3-year swap rate will effectively factor in that decrease and average that out over the next 3 years and say, well, what does that end up as a 3-year average rate? Excellent. So we pay particular attention to that 3-year rate. There can be some volatility. As you see, there's quite a difference in the expectations of that cash rate between the market and some of the major banks. Historically, you wouldn't get that type of difference. There might be a 25 basis point differential between what, say, CBA or Westpac's thinking. But as you can see in that earlier table, there's quite a difference between what the major banks are thinking and what the market is thinking. So that 3-year swap rate has been a little volatile over the last 6 months. But generally speaking, we will look to that swap rate as the basis for our pricing decisions and setting interest rates.
Excellent, thanks. Go on, I'll put you on the spot, Anthony. Well, what's the likelihood or the prediction of the cuts going? What's your view on that? What's the likelihood of this all?
I'd put money on November, Matt. So if you want to put some money against that, please feel free to do so. So I think the market is, and myself, expecting that there won't be a decision around the November other than there'll be a decrease. And then in 2026, historically, Westpac's been pretty good in predicting rates. So I'm hoping that their outlook's going to be correct and there'll be another couple in 2026. That obviously is going to be highly influenced by both the domestic and global economies. But I've got my fingers crossed, Matt, that Westpac's going to be right on this one.
It'd be great to see. Oh, switch on some of the things you're talking about there, just on EVs. You touched on obviously a number of EVs coming to the market. And I believe, there's 20 or so brands coming from China at the moment. How do you see that all going? Like, there's 20 or so brands coming to Australia. Are all of them going to be successful? Do you see some of them? How's your view on that playing out?
Oh, I think everybody would be thinking that not all of those brands are going to survive. Like, there's so many brands coming out of China at the moment in the EV space. Some of that technology is very good. There's also rumours that they get produced in similar factories, possibly the same factory, a number of different brands. So they're definitely very cost effective. I believe there will be consolidation in that marketplace, but as you can see, Australians have been very supportive of that market, with 4 of the top 10 being Chinese brands.
And okay, so just keep on that subject. What about green funding? So it's not just a buzzword anymore. Everyone talks about green funding. It's kind of a business imperative at the moment. How do you see us in asset finance navigating through that? There's significant tax breaks in EVs at the moment for novated leasing, for instance. So just what's your feel on that?
Yeah, maybe if I just touch on the novated EV.
Yeah, of course.
First, and then I'll touch on ESG more widely, particularly from what I see on a global perspective. But the benefit of an EV under a novated program is enormous. When you look at a novated product, the benefit you get is paying for your expenses pre-tax, but the associated cost is the fringe benefits tax on that. So the waiver of the fringe benefits tax means that it's so much more economical to take a novated lease, to take an EV through a novated lease. Now, there's going to be potentially a question around the resale value of that EV. Highly uncertain at this point in time. Gets talked about a lot, whether they're going to depreciate quicker than an ICE. But I think if you've got a relative confidence in retaining your job through that novated lease term, to a large degree, you can dismiss the residual value because you're so far in front in the savings that you get under that novated EV offer. So I would encourage everybody to talk to their clients about the benefits of taking an EV under novated. The ESG space, really interesting sort of dynamic and how the market's evolving. A couple of years ago, in my sector, which is funding and the issuance of debt, there was quite a material number of programs that tried to get an ESG certification, whether that was a green bond or a social bond. A lot of that has come under criticism. It's my personal feeling that the market will evolve from deal specific. This is a green bond because it's got high energy efficient mortgages, or it's a green bond because it's got EVs as the underlying collateral, to more of who's the company that is doing the lending and what is their ESG credentials. Do they have appropriate policies and procedures around ESG? And potentially, is there an external rating so that we can do an easy comparison between lenders? So that space, again, a significant change from 2 years ago, is dominated out of the UK. The UK is probably the most advanced in their thinking around this. To a large degree, with the administration change in the US, that discussions around ESG have gone to the background somewhat. And in Australia, probably not a lot of change. We're still on a similar course that we were before, around trying to get the company itself being in a very strong policy position in terms of ESG.
Excellent. Thanks, Anthony. Appreciate it. Another question here, so try and get this one right. How do you think the government home buyer scheme of 5% deposit will impact finance and interest rates across the board? There's an interesting one.
Yeah, very interesting, Matt. The old saying is, if the government tries to do something, they get the opposite result than what they were hoping for. It scares me somewhat because I feel that house prices are going to perform very strongly over the interest rate cutting cycle. given the strength of the global and domestic economy. And then you overlay that with some interest rate relief, which allows more borrowing capacity for the borrowers. And then you add on some government incentives to drive demand up further. I think that will just put more pressure on house prices.
How do you see that going then? Do you see house prices going up, like you said? Can people still afford to buy property in Australia? What's your thoughts?
Yeah, it's crazy, isn't it, Matt? Like, you wonder how people can afford to buy property in Australia. We're having a very successful year in terms of our mortgage lending. So seeing very strong growth in both our prime and non-conforming lending products. So clearly, yes, people can afford to buy property. I don't think anybody does that lightly, and it's always scary when you go out there and purchase property, given how much it's costing, and you wonder if the price is going to stay the same or go up. It's a massive number that you are purchasing property for, but I still think the fundamentals, people have got good jobs. We do get paid very well in Australia. People are finding ways to come up with that deposit, whether it's through savings or help from the family, and people are buying. So I expect that to continue.
Excellent. Switching gears, like you mentioned AI. I was at a conference yesterday. AI was discussed constantly by every presentation near enough. Do you think it's overblown? What do you think the advancement in technology and the transformation will bring to asset finance? What do you think?
I definitely think that we're probably all a little bit sick of hearing about AI, Matt. But we probably all understand that it's going to be something that we can't avoid and we need to take seriously. And the first cab off the rank is just process automation. So, fingers crossed, some of those roles or some of those jobs that you do that are repetitive and process orientated, ideally will be automated to a degree, which each of us should find comfort in, and we'll be happy to give that up. Personally, I look forward to the day when the Microsoft Outlook can answer my emails for me. So maybe, my email will be responding to your email, Matt, and we don't even know about it. That would be ideal. But the next, after that initial process orientation, I spent a lot of time over the Chrissy break last year just looking at, what does it mean for the next 5 to 10 years? And I think robotics is the real interesting next wave. There'll be a period in between where we see AI agents where you can get process automation across multiple applications, which will be obviously useful. But a massive investment in robotics, which I'm not of the view is going to come in and take jobs in a meaningful way. I think all that will provide is for us to lighten some of that operational load, allow us to focus on more important things like client engagement, and ideally get some of those terrible jobs done that we don't like to do.
Well, we had a question on that basis, and the middle part of that is right. It's how we outsource some of these jobs, but how would you think the government will try and fill some of the gaps? That's one of the questions we've had. Interesting one.
Oh, I think they'll be behind the 8 ball, as they normally are, if I can say that on this call. Yeah. I think it will be very difficult for any institution, including government, to forecast what AI will lead to in the medium term. I think if they see a situation where there is material unemployment as a result of AI, which is not my expectation, then they'll need to address that. But in the interim, probably a wait and see type of approach, where the expectation is that AI is not going to materially upset or lead to higher unemployment.
Excellent. Well, another one that springs to mind for myself as well, and once we get a number of requests from our introducers is, about products itself and demand. There's a lot of demand for pay-as-you-go, short-term financing solutions, leasing, as we mentioned, GFE and novated leasing. What's your thoughts on these sectors, like all these new sectors to market?
Matt, I would throw that question back to you, being the head of product at Pepper. What do you think of those new products, Matt?
That's I thought you might say that. I think the market's changing. I think millennials coming through at the moment. They want different products. They want flexibility. I only see all these options just playing up more and more for us. So yeah, I think flexibility. That's what people are after. They're after flexible products, flexible lending capabilities, and that's what hopefully here at Pepper we're going to do for introducers, is give them that flexibility and new products and new things to the market. So yeah,
and the good thing about what I've mentioned before, the amount of money and favourable funding conditions in the market mean that there is an increase in the number of non-bank originators. And the good thing about an increasing non-bank originator market is they're typically the ones that come through with the niche products.
Yeah.
So they'll start to build up these niche opportunities, which may then become more mainstream. But it provides that footstep for innovation and new product development. So
yeah,
it's a real positive to see the strength of funding conditions leading to an increase in the not only number but also the strength of non-bank originators that'll lead to that product diversification and expansion.
Yeah, I think you're right. I think we just got to listen to the market, and the market is asking us to do different things and look at it differently. And if you look at Europe and the UK, UK and US, they're all advancing in product technology when it comes to finance. So we need to listen to the consumer, and the consumer's asking us to do something. So yeah, watch your space.
Well, the good thing, Matt, is a lot of the delays in product expansion is IT related, because you don't have the system capability to offer that product, and it's going to take you either a lot of time or a lot of money to get that in place. So what we're seeing now is that the improvement in efficiency from our IT team being able to use some of the software development tools and the like is that it's just going to lead to quicker and cheaper outcomes in that space.
Yeah, spot on. Yep. I'll finish with one more, just around sensitivity in the marketplace. As you mentioned, it's a highly sensitive market. How do you think we're going to tackle the pricing pressures? How we're going to tackle this over the next 12, 24 months? How's Pepper going to look at this?
You mean pricing pressures from a margin perspective, a Pepper margin perspective?
Yeah, correct.
I think we're in a really fortunate position because we benefit from economies of scale. So, we got a $20 billion balance sheet, and asset finance makes up $6.5 billion of that. So it's a large scale business, and to a large degree, lending is a scale game. So it's much easier for you to be an efficient and profitable lender when you have scale. When some of the newer players come in and they're trying to get that scale, that's when it's difficult. That's when increases in competition, where margins are declining, puts pressure on your profitability and puts pressure on your ability to put capital aside to continue to grow. The real positive thing today is that there's quite a number of lenders that don't make a lot of money, and historically may not have had the capital to continue to expand their businesses. But not only are the funding conditions for debt really positive, but the funding conditions for capital, actually getting capital injections from external investors or raising capital through alternative methods, is really favourable today as well. So that's allowing some of these smaller players to be quite strong in terms of their profile and ability to continue to absorb some of these margin pressures, Matt.
Excellent. All right, I think I've given you enough questions, Anthony. I think I'm going to wrap it up there. If we've got no more questions from the audience, I'd just like to say thank you very much. Presentation was amazing. It was great insights. I'm sure everyone on the call had something to think about after this call, and it's gives us all something to think about. So thanks very much. Appreciate everyone joining today. We'll send a wrap up session after this. We'll also send any questions we couldn't get to today. We'll send responses to afterwards. So thanks very much for all joining. And Anthony, I appreciate you've been on the call.
Thank you, Matt. And we can talk about back to fallen trees on the train.
I can't wait.
Thanks a lot.
See ya.
Bye, everyone.
Bye-bye.